Hey Forex Militia, this is Parsival, and what I'm going to share with you is an ebook called High Probability Trading Setups for the Currency Markets, written by Katie Lien and Boris Schlossberg. This is an Investopedia ebook that I found way back in 2006 that gives you some very good mindset. Basically, first, what it actually gives you is it gives you 10 rules, and then after the 10 rules are basically given, it actually gives you trading setups. It gives you strategies, about 8 of them, that you can possibly put into effect. You can test it out yourself. But for right now, what we're going to go over are the 10 rules that Katie Lien and Boris Schlossberg basically go over. All right, this is 1 through 3, and there will be 2 other videos with the 4 through 6 and the 7 through 10. Okay, so without further ado, I will let Mia, my personal assistant, read this book for you, and then I'll come back with some commentary on how you can possibly implement the rules. Okay, here we go.
Ever. Part 1: 10 Reasons Why We Love the Currency Market. Introduction. After having traded everything from stocks to futures to options, the currency market is hands down our favorite market to trade because 1. You can trade to any style. Strategies can be built on 5-minute charts, hourly charts, daily charts, or even weekly charts too. Massive amount of information are charts, real-time news, top-level research, all available for free. 3. All key information is public and disseminated instantly. 4. You can collect interest on trades on a daily or even hourly basis. 5. Lot sizes can be customized, meaning that you can trade with as little as $500 at nearly the same execution costs as accounts that trade $500 million. 6. Customizable leverage allows you to be as conservative or as aggressive as you like. The cash on cash or 100-1 margin. 7. No commission means that every win or loss is cleanly accounted for in the P&L. 8. Trade 24 hours a day with ample liquidity, $20 million up. 9. No discrimination between going short or long. The no uptick rule. 10. You cannot lose more capital than you put in. Automatic margin call. This book is designed to help you develop a logical, intelligent approach to currency trading. The systems and ideas presented here stem from years of observation of price action in this market and provide high probability approaches to trading, both trend and counter-end setups, but they are by no means a surefire guarantee of success. No trade setup is ever 100% accurate. That is why we show you failures as well as successes, so that you may learn and understand the profit possibilities, as well as the potential pitfalls of each idea that we present. However, before we reveal the setups, we would like to share with you our 10 favorite rules for trading success. Having watched the markets on a tick-by-tick basis 24 hours a day, year after year, we, perhaps more than anyone, appreciate the fact that trading is an art rather than a science. Therefore, no rule in trading is ever absolute except the one about always using stops. Nevertheless, these 10 rules have served us well across a variety of market environments, always keeping us grounded and out of harm's way. Therefore, we hope that you find both the rules and the high probability setups of interest and value in your pursuit of profit in the currency markets. We wish you great trading. Katie Lien, Boris Schlossberg. Part 1: Top 10 Trading Rules. 1. Never let a winner turn into a loser. Repeat after us. Protect your profits. Protect your profits. Protect your profits. There is nothing worse than watching your trade be up 30 points 1 minute, only to see it completely reverse a short while later, and take out your stop 40 points lower. If you haven't already experienced this feeling firsthand, consider yourself lucky. It's a woe most traders face more often than you can imagine, and is a perfect example of poor money management. The FX markets can move fast, with gains turning into losses in a matter of minutes, therefore making it critical to properly manage your capital. One of our cardinal rules of trading is to protect your profits, even if it means banking only 15 pips at a time. To some, 15 pips may seem like chump change, but if you take 10 trades, 15 pips at a time, that adds up to a respectable 150 points of profits. Sure, this approach may seem as if we are trading like penny-pinching grandmothers, but the main point of trading is to minimize your losses, and, along with that, to make money as often as possible. The bottom line is that this is your money. Even if it is money that you are willing to lose, commonly referred to as risk capital, you need to look at it as a you versus the market. Like a soldier on the battlefield, you need to protect yourself first and foremost. There are two easy ways to never let a winner turn into a loser. The first method is to trail your stop. The second is a derivative of the first, which is to trade more than one lot. Trailing stops requires work, but is probably one of the best ways to lock in profits. The key to trailing stops is to set a near-term profit target. For example, if your near-term target is 15 pips, then as soon as you are 15 pips in the money, move your stop to break even. If it moves lower and takes out your stop, that is fine, since you can consider your trade a scratch and you end up with no profits or losses. If it moves higher, by each 5-pick increment, you boost up your stop from break even by 5 pips, slowly cashing in gains. Just imagine it like a blackjack game, where every time you take in $100, you move $25 to your do not touch a pile. The second method of locking in gains involves trading more than one lot. If you trade 2 lots, for example, you can have 2 separate profit targets. The first target would be placed at a more conservative level, that is closer to your entry price, say 15 or 20 pips, while the second lot is much further away, through which you are looking to bank a much larger reward to risk ratio. Once the first target level is reached, you would move your stop to break even, which in essence embodies our first rule: never let a winner turn into a loser. Of course, 15 pips is hardly a rule written in stone. How much profit you bank, and by how much you trail the stop, is dependent upon your trading style, and the time frame in which you choose to trade. Longer-term traders may want to use a wider first target such as 50 or 100 pips, while shorter-term traders may prefer to use the 15-pip target. Managing each individual trade is always more art than science. However, trading in general still requires putting your money at risk, so we encourage you to think in terms of protecting profits first and swinging for the fences second. Successful trading is simply the art of accumulating more winners than stops.
Okay, so on this first rule, never let a winner turn into a loser, protect your profits, you basically get the gist of what they're talking about. They want you to basically make sure that you implement a strategy, a system within your strategy to basically protect whichever way that the market basically moves. So either you put a trailing stop, you do the partial close break even, you trade 2 positions, you take off half at a lower point, so you break it up into basically 2. And so in that way you can basically protect your profits. I basically have an EA that I found on the internet that I'm going to basically show you. So let's go to the charts. Okay, so here we are on the charts, and the basic idea is this is what you would call a trade manager. I don't know if you guys know anything about that, but trade manager will basically you can affix it to your chart. This is an an expert advisor, and you can fix it to your chart, and it will basically take care of the trade. What I also did with this was I have this on my smartphone, and I basically get I set it so that you can basically get emails letting you know what's going on with your trades. To do that, I'm going to suggest that you read the manual, read the manual, read the manual, so that you'll know all of the functions of this EA. And what I'm understanding is you basically have to put this on each of the charts that you're basically trading on. All right, there are some trade managers that basically will basically keep account of each trade that you basically have on your whole platform. But this one is just, I believe, for each individual currency that you're basically trading. All right. So this I got from Forex Toolshed, and they are a company that they are no longer in business. They basically had this tool on ClickBank, but now they're just giving it out for free. So it's not supported, but it does work. All right, so that's something that I'm going to put in the description. It's a link. It's for free, and I will. I don't support it, but not that I don't support it. I support it, but it's not a program that I can actually correct or add things to, because I don't know how to program MT4. So with that, I will give it back to Mia, and she is going to go over number 2. Logic wins, impulse kills. Take it away, Mia.
2. Logic wins, impulse kills. More money has been lost by trading impulsively than by any other means. Ask a novice why he went long on a currency pair, and you will frequently hear the answer: "'Cause it's gone down enough, so it's bound to bounce." We always roll our eyes at that type of response, because it is not based on reason, it's nothing more than wishful thinking. We never cease to be amazed how hard-boiled, highly intelligent, ruthless business people behave in Las Vegas. Men and women who would never pay even $1 more than the negotiated price for any product in their business will think nothing of losing $10,000 in 10 minutes on a roulette wheel. The glitz, the noise of the pits, and the excitement of the crowd turn these sober, rational business people into wild-eyed gamblers. The currency market, with its round-the-clock flashing quotes, constant stream of news, and the most liberal leverage in the financial world, tends to have the same impact on novice traders. Trading impulsively is simply gambling. It can be a huge rush when the trader is on a winning streak, but just one bad loss can make the trader give all of the profits and trading capital back to the market. Just like every Vegas story ends in heartbreak, so does every tale of impulse trading. In trading, logic wins and impulse kills. This maxim isn't true because logical trading is always more precise than impulsive trading. In fact, the opposite is frequently the case. Impulsive traders can go on stunningly accurate winning streaks, while traders using logical setups can be mired in a string of losses. Reason always trumps impulse, because logically focused traders will know how to limit their losses, while impulsive traders are never more than one trade away from total bankruptcy. Let's take a look at how each trader may operate in the market. Trader A is an impulsive trader. He feels a price action and responds accordingly. Now imagine that prices in the euro to US dollar move sharply higher. The impulsive trader feels that they have gone too far and decides to short the pair. The pair rallies higher, and the trader is convinced, now more than ever, that it is overbought and sells more euro to US dollar, building onto the current short position. Prices stall, but do not retrace. The impulsive trader who is certain that they are very near the top decides to triple up his position, and watches in horror as the pair spikes higher, forcing a margin call on his account. A few hours later, the euro to US dollar does top out and collapses, causing trader A to pound his fists in fury as he watches the pair sell off without him. He was right on the direction, but picked a top impulsively and not logically. On the other hand, trader B uses both technical and fundamental analysis to calibrate his risk and to time his entries. He also thinks that the euro to US dollar is overvalued, but instead of prematurely picking a turn at will, he waits patiently for a clear technical signal, like a red candle on an upper Bollinger Band or a move in RSI below the 70 level, before he initiates the trade. Furthermore, trader B uses the swing high of the move as his logical stop to precisely quantify his risk. He is also smart enough to size his position so that he does not lose more than 2% of his account should the trade fail. Even if he is wrong like trader A, the logical, methodical approach of trader B preserves his capital, so that he may trade another day, while the reckless, impulsive actions of trader A lead to a margin call liquidation. The point is that trends in the FX market can last for a very long time. So even though picking the very top in the euro to US dollar may bring bragging rights, the risk of being premature may outweigh the warm feeling that comes with gloating. Instead, there is nothing wrong with waiting for a reversal signal to reveal itself first before initiating the trade. You may have missed the very top, but profiting from up to 80% of the move is good enough in our book. Although many novice traders may find impulsive trading to be far more exciting, seasoned pros know that logical trading is what puts bread on the table.
Okay, for number 2, logic wins, impulse kills. We basically get the gist of that. As new traders, we basically come into the market thinking that we can make a boatload of money very quickly. And very quickly we blow accounts, we lose money, because we don't have a strategy to basically implement when we go into the market. As this thing went over, people basically will go into Las Vegas and just, because of the flashing lights and the excitement, we think it's very exciting, right? All right. Down here, this is basically talking about, although many novice traders may find impulse trading to be far more exciting, seasoned pros know that logical trading is what puts bread on the table. So with that, if we are going into a casino, which is the Forex market, then we are playing blackjack and we're counting cards. We have a proven strategy that basically works time and time again, and we're putting it into effect. All right. This is not a coin flip. In the markets, right? In these Forex markets, we know that it can either go up or down, right? And as we know, it basically, if you flip a coin enough times, 1,000 times, it will come out somewhere in the range of 50%. But interestingly enough, in the Forex market, 90% of people lose in just markets overall. But in the Forex market, 90% of people lose. Why is that? Okay, because it is rigged. It is rigged for people to basically lose. This is why on my channel I basically promote sentiment trading. Do not trade with the herd, because they form areas of liquidity that the hedge funds, the big money players, the big boys will basically seek out to fund their positions and stop people out. So I have a video that I'll probably leave a card to, Hitch a Ride with the Smart Money, to basically have you look into sentiment trading when you take your trades. We are when I basically also will promote that you will also look to take strong versus weak. That is another rule that's coming up later. But for right now, That's about it. So I will let it go back to Mia and take it away, Mia.
3. Never risk more than 2% per trade. This is the most common and yet also the most violated rule in trading, and goes a long way towards explaining why most traders lose money. Trading books are littered with stories of traders losing 1, 2, even 5 years' worth of profits in a single trade gone terribly wrong. This is the primary reason why the 2% stop-loss rule can never be violated. No matter how certain the trader may be about a particular outcome, the market, as John Maynard Keynes used to say, can stay irrational far longer than you can remain solvent. Most traders begin their trading career, whether consciously or subconsciously, by visualizing the big one, the one trade that will make them millions and allow them to retire young and live carefree for the rest of their lives. In FX, this fantasy is further reinforced by the folklore of the markets. Who can forget the time that George Soros broke the Bank of England by shorting the pound and walked away with a cool $1 billion profit in a single day? But the cold hard truth of the markets is that instead of winning the big one, most traders fall victim to a single catastrophic loss that knocks them out of the game forever. Large losses, as the following table demonstrates, are extremely difficult to overcome. Amount of equity loss, amount of return necessary to restore to original: 25%, 33%, 50%, 100%, 75%, 400%, 90%, 1000%. Just imagine that you started trading with $1,000 and lost 50%, or $500. It now takes a 100% gain, or a profit of $500, to bring you back to break even. A loss of 75% of your equity demands a 400% return, an almost impossible feat, just to bring your account back to its initial level. Getting into this kind of trouble as a trader means that, most likely, you have reached the point of no return, and are at risk for blowing your account. The best way to avoid such fate is to never suffer a large loss. That is why the 2% rule is so important in trading. Losing only 2% per trade means that you would have to sustain 10 consecutive losing trades in a row to lose 20% of your account. Even if you sustained 20 consecutive losses, and you would have to trade extraordinarily badly to hit such a long losing streak, that the total drawdown would still leave you with 60% of your capital intact. While that is certainly not a pleasant position to find yourself in, it means that you only need to earn 80% to get back to break-even, a tough goal, but far better than the 400% target for the trader who lost 75% of his capital. The art of trading is not about winning as much as it is about not losing. By controlling your losses, much like a business that contains its costs, you can withstand the tough market environments, and will be ready and able to take advantage of profitable opportunities once they appear. That's why the 2% rule is one of the most important rules of trading.
Okay, so number 3, never risk more than 2% per trade. This one is essential because we want our strategy to basically play out as many times as possible within the market, to basically spread out the sample. Right? Because we've back tested, and we've back tested enough to know that we have an edge in the market. Right? Now, we know that our system is not the holy grail, which is what Parcel is looking for, right? And it will lose sometimes. So we want to make sure that when we lose, we don't lose a significant part of our capital. We are making sure that we preserve our capital enough so that we can continue to stay solvent within the markets. Because as you can see based on these charts, if we lose significant amounts of our equity, we will have to fight back even harder to basically get back to a break even. Okay? So 2% will basically give us somewhere 50, basically 50 trades. 50 trades because basically that's divide. We have 100% of capital divided by 2, 50 trades. All right. If we trade 1%, enough said, we get 100 trades, and we want to make sure that once again our strategy plays out. So to do this, I basically use a calculator to calculate out how much I'm going to basically risk. All right, and the calculation of basically getting the 1 to 2% is based on your account balance. So let me just take you over to FX Blue where they have a position size calculator. Okay, so here we are on FX Blue's site, and it's under the market data tab all the way at the bottom. They have a lot of tools, but they have right here the position size calculator. And that comes up, and as you can see, it will ask you the amount that you're going to risk, and it's fixed, so you basically will put in the amount of cash that you want to basically risk based on the currency that you are basically you've deposited, the instrument, and the amount will basically come out here. So stop loss type pips. There you go, 135 fixed. The amount of cash that I want to. Okay, there's two. I'm sorry. There we go. We want to risk 5%. I mean 2%. My bad. 2%. And so, with an account size of 2,500, right, on the euro yen, pips 135. So, this is in units, right? But this is in the lot size. So, it's only a small amount, a 0.04 lot size that we're going to basically trade with this size account and this much risk. Okay? So, this will basically help you to determine exactly what you need to basically put on every single trade. Now, I've heard somewhere that you should only, even though you're going to go ahead and risk 2%, 1% or 2% of your account, right? The most that you should risk on a series of trades, right? A series of trades. Let's just say you're trading the euro yen, you're trading the pound dollar, you're trading the Aussie Swissy. All of those three trades should only add up to at least, I learned 20%. But if you want to take it down to 10, it's up to you, right? But because with that amount on, and if you lose all those trades, that'll be 20% or 10% of your account, okay? So to start out when you're new, I would say just 10%, okay? So basically risking 2% per trade, you would have 5 trades that you can basically put on for 5 different currency pairs, okay? All right, so with that, I'm once again going to promo a software that I want to promote to you called TradeMiner, and I'm going to get into that in the next segment. Okay, this is TradeMiner for Forex, and this is a promo for TradeMiner Forex and TradeMiner stocks. There are 2 trades that are coming up within the next couple of days. This one is on March 30th to April 7th. It has an 80% accuracy. All right, it's basically the statistics for 11 years, and you can see that right there. And the average profit is about $273. biggest profit 593, and average profit is about 14% return on money. Drawdown 332. The trade that's right after this one, after March 7, will be the pound, right? And that goes from April 7th to April 19th. 80%. The stats from 7 years, and the biggest profit is $2,246. The average is 962. The drawdown is 1,454. All right, so the average profit return on money is 53%. All right, that's for these two. What I believe I'm going to do is I'm going to put this on my website. So if you wanted to basically download it and take a look at it, I'll put that over there. And now, TradeMiner stocks. I am going with the Yum brand, bullish, right? 15 years of stats, 90% chance for this to actually go long. Now, for this, I don't believe that you should actually buy Yum. I think what you should do is you should trade the options. So this is good for basically options, and the win rate of 90% plus, either buying the option knowing that it's going bullish, or selling an option to just collect premium knowing that it's going to go up. Since you have a direction, right? You can basically make some money off of this. That's what I would suggest. Okay. Once again, I don't normally do this, but I should do it. I am not a financial advisor. I am giving this to you as a promo and as education. Trade at your own risk. Do your own due diligence. Do your research to basically understand what type of risk that you're taking. Okay? Once again, this is for educational purposes only. All right? I have been taking trades on TradingView. I've been taking trades on TradingView over the last 3 months or so, since about January, and a lot of these trades are 90% winners, like a 90% accuracy over from the stats that were given from TradeMiner stocks. And so far, I am in a gain. Right now, I have basically, of my closed trades, I have a 59% accuracy, right? Okay. But I also do have 5 positions on right now, which 4 of them are in profit and 1 of them is at a loss, small loss. But so far, as of March 17th, St. Patrick's Day, happy St. Patrick's Day, I am up about 4,500 and excuse me, $4,548. Okay, and I have an unrealized gain of $1,100. So that's right now, like I said, in my trading history of my closed trades, this is about 59% accuracy. All right, so that's better than 50, and right now, TradeMiner stocks is profitable. Now, one thing I do have to say is I do believe the stock market is at about 5%. So right now, this is actually lagging the stock market, the S&P 500 that is, by a small amount. But I'm going to continue to trade it, and I will give you the stats of what this comes out with you in later videos. And with that, I will say knowledge is power. Be power hungry, and power to the people. This is Parsival, signing out.